In this video, I will show you the exact process that I use to pick stocks that are beating the market over the long run. Since the inception of this strategy on my portfolio, so when I shifted from dividend portfolio to a growth portfolio to have the goal of beating the market, the return has been 30% annualized, almost double that what the S&P and the Nasdaq returned during the same time. Okay, so yes, for now it's been a short time that I'm using this protocol, but for now it has been working pretty well and the year starting pretty well as well. So the first step of all of this is to set up good goals. It's important for you to determine what is your portfolio goal. How long can you stay in the market? Okay, can you stay for 3 years, for 5 years, for 10 years? For example, one time I had a client asking me, okay, I have 5 years to invest because I know that in 5 years I need to spend this money. I just don't want to let it in bank account. How can I invest? So someone with a deadline like this will not invest the same way that someone that can hold a position for 10, 15, 20, 30 years. So this is important to know before investing. Also, is beating the market something important to you? Because if you don't care, maybe you will go on another strategy. Maybe this strategy is not for you. I will show you the process that I use to beat the market with the goal of beating the market. If you don't have this goal, maybe this strategy will not be for you. Are you a long-term or short-term investor? Same for me. I invest in companies that I would like and believe that I can keep in my portfolio for the next 10 years minimum. So if you want just to find a bet to do for the next 1 year or two, this will not be for you as well. How much can you invest? It's important to determine this before starting your journey. How often you can invest as well. And then we arrive on step number 2, investment ideas. So the first thing that I use, it's my main source of ideas, is screeners. So for this I use FinChat or Guru Focus. Okay, that's the two main sites that I use to screen some nice company based on quantitative criteria. Also, you can find some ideas on some YouTube channels, Twitter accounts, Substacks account. You have some great investor out there publishing some great content with some great investment idea. By the way, you can follow this channel. You will get also probably some good investment ideas on it. Everyday life things, like what is the brand of your shampoo? What is the company behind your shampoo? What is the brand of your computer? What is the brand of the system into your computers? Semiconductor into your computer, your lights, your oven, your pans, the fruit that you eat, they come from a special shop or something like this. Where do you go to do your grocery? What is your car brand? What is a component in your car brand? Etc. etc. This is a good way also to find some nice investment ideas. You also have some investors clubs. This, I'm not into any of them, but it can be some good source of ideas. Investment funds letter, this can be very good. You have some great investors who have great funds and they do shareholders letter every year, every month, every semester. This can be also a good place to find some nice ideas. Of course, super investors. So you can find what we call super investors is people who have at least $100 million of asset under management. So they have to register and file the 13F filing on for the SEC, and all of this is registered on Dataroma or Stock Circle. So you can have some nice idea. Of course, here find super investors that are aligned with your strategy. Okay, for me it's quality investing plus potentially beating the market. So I want to see investors who have actually beat the market for the last years. And you can find this on Dataroma or Stock Circle. Also, it can be interesting to look at underperforming industry for the last year or two, even underperforming countries, companies, etc. You can get some great deal in this because the whole market is down. So maybe some of them can have a very good growth potential in it. And also problem in a company which is facing a trial, which is facing a problem that it will not affect the business and the numbers for the next 10 to 20 years, but for 1 year or two, it can be problematic for the numbers. So investors are getting out of it. Here you can get some great investment idea and very good deal at very good valuation. To be honest, if a company is undervalued, most of the time it's because they're facing a problem. Generally, if they're not facing any problem or if there is not something going around, it's very difficult to have deep undervalued company. You may have some well-valued company, but deep undervalued seem a bit difficult for this, okay? Step 3, when you get all of this idea, you need to filter them. You cannot analyze all the stocks that you will find with all those things. You need to create good filter. This is my filter that I use every day when I research stock. First one, I want a return on invested capital or a return on capital employed over 15%. If it's under, I pass, okay? Why 15%? Because the average for the S&P 500 is between 12 and 16%, so 15% seems good. I want companies with a forward PE, price earning ratio, under 30. It's something important for me because over this, for me, it's the valuation is way too high most of the time. You can have some exception, but most of the time, the valuation will be too high if it's over 30. A net debt to EBITDA under 3, it means that in less than 3 years, they can pay full debt with the EBITDA in under 3 years, okay? An operating margin over 15%, because it's same higher than the average for the S&P 500. Also government, which is not the main shareholder or client, or even not shareholder at all. This in United States is not really a problem, but I know that for me in France, for example, you have a lot of companies which have government investing in it. In Europe, you have some also, which are like half public, half private company. It's a big mess. Also in some country like China, most of the time government have something to do in it. So you need to check that they don't have a too big influence or they are not the main client. If one government is the main client of the company, it means that they are one client away from not bankruptcy, but from a big decline in number, or if the government change radically, it can be a problem. So government, I don't want them to be the main client, at least one government the main client and the main shareholder. Also, I am looking for company with a EPS growth, so for the past and also for the future. Now, that we finish the step 3 filter. So your company, you put all this filter, the company pass all of this, you can start to analyze, and first you will analyze the number. In the numbers, what you want to see, you want to analyze the growth, the debt, efficiency, allocation, dividend, and then value. Value, we can even do it after, at the end, after analyzing the quality of the business, but this is the way I do. So first, growth, okay? I'm checking the growth of revenue, free cash flow, and earning per share. I'm looking for cumulative annual growth rate for the last 10 years, 5 years, potentially 3 years, and the last one, and obviously the future one, because you can have a great growth in the past, but if you don't have growth in the future, it will not be interesting. I'm trying to find things where they are higher than 10%. For the revenue, it's fine if it's between 6 and 10%, but for the free cash flow and earning per share, I want higher than 10% almost for everything, except if it's a deep undervalued, okay? But if there is no growth, I'm not in. I need to have at least 5-6% growth for the business. If it's only 1% growth or 0, I'm out, or even negative growth, I'm out, okay? You would like to see higher growth than competitors and higher growth than market. And if there is a decrease in growth, like during the last 10 years or 20 years, if you see a decrease in the growth of those numbers, try to understand why. Is it because maybe it can be a problem that was identified at this moment and then everybody forgot about this problem and it can appear again. So it's important to understand why you had a decrease of growth in the past. Was it a problem with the whole market? With maybe it was a recession or something like this? So then should be fine. But if it's something that the company was facing, maybe it's something that can happen again. So you want to know before. Try also to avoid cyclical business and business that grow just super fast. Like they have normal growth of 5% per year and suddenly they have 45% per year and the next year it's supposed to be 50% and it's like this. I don't really like when it's a very big growth suddenly. I prefer like account 10% per year, which for me it's more accurate and also easier to do a discounted cash flow for the valuation for the future of the analyst. Okay. Now, after analysis the growth, you need to analyze the debt. Okay. So for debt, I'm going for net debt to EBITDA. I want it under 3. Okay. And also the interest coverage. Interest coverage, you have it by it's EBIT compared to the interest that the company pay. I want it to be higher than 8. So here, same, you need to compare with competitors and market, okay? Check how it evolved. You would like it to, for the interest coverage, you would like it to increase with time, and the net debt to EBITDA, you would like it to decrease with time. Also, the long-term debt, in the perfect world, it would be decreasing year after year, but then it's not because you have the debt growing up that is automatically out of a problem, but you need to understand why it's growing, and the best way it's when it's declining over time, so better when long-term debt is decreasing. Also, you can look at the debt grade from agencies like Moody's, Standard & Poor's, Fitch. Try to stay on investment grade rate, which is over triple B, if I remember well. So try to always have company over this, but generally if your company have a net debt under 3%, under 3, interest coverage over 8, plus a good growth in the past and for the future, they generally have a good grade from those agencies, okay? Then I want to look at the efficiency, okay? So here, again, I'm looking at return on invested capital or return on capital employed. I want it over 15%, better than industry, better than competitors, better than the market, okay? Higher than the market, because if you want to beat the market, you need to have more efficiency than the market. Is it growing? Okay, check for the last 10 years, because when this is growing, it may be because the competitive advantage is growing, because the management is getting better and better. So it's not, it doesn't put your company out if it's not growing or if it's decreasing a bit, but it's always something good to see that it's growing. Then does it have a good regularity? In a sense that if one day you have 15%, the year after you have 12%, the year after you have 25%, the year after you have 8%, you don't really like it. You prefer to be over 15% and stay like this, stay around this, and not big change year over year, okay? Then also same with operating margin or free cash flow margin, higher than 15%, better than industry, higher than market, growing, okay, check for at least 10 years. And here it's interesting when it's growing because it shows generally a competitive advantage. I value way more on growing operating margin because it's something very good. And also, does it have a good regularity in the numbers? You don't want to have like up, down, etc. Then you check at the allocation. Is the board, the team, good capital allocators? So you can watch at stock-based compensations, 110% generally. Compare also with industry and history of the company. If the company have been doing 20% all the time during the company existence and it's still beating the market, maybe it's something fine, okay? Also the capex to operating cash flow, under 20%. If too high for the last 10 years, okay, you always compare with industry and the past, probably some issue with the business itself. If the business needs a high capex to run properly, it can be a problem. It can be a problem because if one day they cannot spend all this money for capex, the business will not run. So try to find business with, I'm not saying super low capex, but around 20% is good, like, or even under 20% is good, but around 20% compared to competitor. And then you have share outstanding. Are the company doing buybacks or no? Is it growing or decreasing? The goal is to have decreasing share outstanding because it creates more value for shareholders. You try to avoid company with growing, especially the ones that grow fast. If it's a little growth sometimes, it can be fine, it can be even better sometimes than to have debt, but generally you want it to decrease. Then you can look at the dividend, okay? Here you will look at the payout ratio, can be also free cash flow payout ratio. So payout ratio is with the earnings, free cash flow payout ratio is compared to the free cash flow. Here, my under 50%, sorry. For some tech company, you can go even under 30%, but try to not have it too high because it's money that cannot be used to invest in the business and continue to develop the business. Also, you want it to be lower than competitors. Okay, you want to check also at the history. Stay away from irregularity in dividend payments. Okay, you don't want a company that have a dividend on $1, the next year $1.2, and the year after 50 cents, the year after $3, the year after 40 cents. You want something that grow calmly year over year and eventually more than 10% a year. Okay, so a good growth potential. How do you think it will grow in the future? Generally, it will follow the revenue or earning per share growth. So try to have something that can grow and can have a good growth for the future. Step 5 will be value. Okay, so here I will give you different techniques that I use to value stock. So first, you can look at the PE ratio or the price to free cash flow. Here, check the history, at least for 10 years. Okay, can work also for forward price earning. As you prefer, some people prefer to use a forward PE, some other the normal PE. I mostly use a forward PE, but you can also use the normal one. If now the PE, the actual PE is under the historical PE, like for the last 10 years, the average for the last 10 years, it can be good. It will not automatically say it's undervalued. You need to check all of the things before, but it can be a good sign, okay? I generally don't go over 30 PE ratio. Like I don't go over 30. I can have some exception for this, but generally I try to avoid going over 30. Now you can also do an estimate for the next 3 to 5 years. I will show you an easy DCF technique. The goal is to estimate what cumulated annual growth rate you can have for the next 3 to 5 years. Okay, so I will show you right now an easy and fast one to do. By the way, let me know in the comment section if you'd like a video on one more advanced one, okay? A more advanced DCF that will take more things into consideration. Let me know in the comment section. Okay, so the formula for this, it's pretty easy. The return, so the cumulated annual growth rate for the next 3-5 years is equal to valuation for this period plus the dividend yield plus the earning per share growth. So the valuation return formula is historical price earning divided by the actual price earning, exponent 1 divided by the number of years of projection minus 1. Generally, number of years of projection, you will use 3, 5, or eventually 10, but most of the time it's 3 or 5, okay? Here an example with real numbers. We have an historical PE of 20, actual PE of 25, and projection will be over 5 years. So the valuation return will be equal to 20 divided by 25, exponent 1 divided by 5 minus 1, which is equal to minus 4.36%. To this, you will add the dividend yield and the EPS growth estimate. Okay, it's for the future, so it can be only an estimate about this. So here, the expected return will be minus 4.36% plus 2% plus 10%, which is equal to 7.64%. So you can expect a growth rate, a cumulative annual growth rate of 7.64% with this example here for the next 5 years. Because we use 5, we can use 3 and see what it will give, okay? Now that you have analyzed all the number, you can go to analyze the quality. You can also do the value of the business after analyzing the quality. Like this, you're less biased. If the company have a good value, you will be tend to buy and buy fast. So maybe you can do quality before value. But here, I analyze the quality of a business. So first, I'm asking myself, does the company have a moat? You can have some good articles on Morningstar about it. Also on Interactive Broker, if you go on fundamentals of the company, you will have the Morningstar grade plus a full review from the analyst who cover all of this. So it's interesting to read because you can understand what's the problem, what's good with the company, and why they have this moat, why the trend of this moat is high, low, etc. You will do also a SWOT analysis. So a SWOT is you need to analyze what are the strengths, the weakness, the opportunity, and the threats for the company. It's important to do all of this to understand it well. Are the directors serious? Okay, when they are making a guidance, a prediction, as they follow, does the result come to it, or they're always doing guidance, but it never happen? Okay. Also, directors that don't waste too much time on doing plenty of guidance and so on can be something good. What is a track record? Okay, when they say something, does it happen or no? Is it, and try to find the track record. You can just go on the conference call, on the document, the report that they have in investor relations, and you can check all of this. Are they market leader? Why their products are better than others? Because you would prefer to invest in market leader or companies that have better product than others. Is it a growing market? It's always easier to swim in the direction of the river than to swim against the river. So if it's a growing market, the company have way more chance to continue to grow. If market close for 10 years, are you comfortable owning shares of this company? Ask yourself this. Are you able to keep this company in your portfolio if you know that you cannot sell for the next 10 years? Or maybe will you put your money on another company? This is important to know. Do you understand the business model? Very important. If you don't understand, just put it out. It's okay. You don't need to understand every company. Everybody have a circle of competence. So keep analyzing companies that you actually understand. And for all of this, to find all of this information, do your research. You can read some articles, you can read reports, you can listen or read to conference call transcript. You can watch analysis on YouTube, internet, etc. You have some nice articles and analysis on Seeking Alpha as well. What you can also do is to download for the last 5 to 10 years all the documents shared by the company, all the reports, annual reports, everything, okay? Shareholder and report, everything. You can upload it in an AI, ChatGPT or whatever, and then ask question to ChatGPT, asking him to answer only from the document that you have submitted. You can have some good help with this, and it can help you to go faster in your analysis. So now that you have analyzed the business, you understand it well and so on, here's the last step, decision making, okay? How to take a good decision. First, I would recommend you to do a short presentation of the company to a friend, okay? Try to do it to a friend which doesn't have any knowledge about the company, eventually knowledge about stock markets and all of this, to see if you're able to explain in 5-10 minutes maximum the business to someone who doesn't know anything about it. If you're not able to explain it easily and the other person understand it, maybe you didn't understand well the company. So go back to work, go back to analyze, or go to another company that you may understand easier. Are you in FOMO? Ask yourself. Do I need to buy fast this stock? Now that I finish my analysis, do I feel I need to buy fast this stock or no? Generally, if you feel you need to buy fast, maybe you miss some points, or maybe it's not a good idea, because generally, if it's a very good business, it will not change anything on the long run if you buy it 15% higher or 15% lower. So if you feel that in the next 2 or 3 days the business can change and the stock can take 15% or minus 15%, maybe you miss some point and maybe it's a bit too speculative for you. Do you have at least 20% margin of safety for your valuation? For everything, did you take at least some margin of safety? Have you identified at least 10 problems that the company could face? Because it's good to do SWOT analysis, but if you didn't identify at least 10 problems, 10 challenges, you may get some trouble here. Remember, investing, the most important thing is not to invest in company which doesn't have problem. It's important to invest in company where you understand the problem, because when the problem is clear and you understand it, you can estimate if the company and the directors will be able to go over it or no, will be able to solve it or no. Like by definition, a good company is a company that solves problems. So this is important. Does the company have problems? And have you identified at least 10 of them? And if you identify 10 of them, are you still into investing in it? So that's all the process that I use to do my stock picking. I will conclude with this good sentence from Warren Buffett. We try to buy businesses with good to superb underlying economics run by honest and able people and buy them at sensible prices. That's all I'm trying to do. I will say kind of the same, buying great business, well managed, easy to understand, and pay good price for this to expect good return on the future. And always, of course, invest on the long term. If you like this video, thumbs up on it. Remember to subscribe to the channel and let me know in the comment section if you have some other steps that you do when you analyze a stock. It will be interesting to discuss about it and discover how you analyze your stock and how you create your portfolio.